You are probably hearing a lot of talk right now about inflation expectations, bond yields, tips, and why markets suddenly seem nervous about inflation again. And if you're wondering what any of this actually means for your portfolio, your stock, your tech holdings, or even the Federal Reserve, then stay with me. In this video, I'm going to break it down from an absolute beginner's level all the way to advanced level in plain English. No jargon, no economics degree required here. And by the end of this video, you will understand why inflation expectations are rising, what break-even inflation rates actually are, why tech stocks get nervous when real yields rise, and why the bond market may matter more right now than earnings. Let's start with the basics here. Most people think inflation is just prices going up. And yes, that's true. But financial markets care less about today's inflation and more about future expectations. In other words, what do investors think inflation will average over the next 5 years? This matters because financial markets are forward-looking. Stocks don't wait for inflation to happen. Bond markets don't wait either. They react to expectations. Now, one of the most important ways markets measure inflation expectations is through something called the break-even inflation rate. Sounds complicated, it's actually very simple. You compare two government bonds. One is a normal treasury bond issued by the US government, the other is a TIPS bond. TIPS simply stands for Treasury Inflation Protected Securities. Normal treasury bonds give you a fixed return, a nominal yield. TIPS bonds adjust with inflation. So by comparing the yields between the two, markets can estimate what inflation is expected to average over time. This is the break-even point where an investor would be indifferent between holding either bond. Very simple example. Let's say a normal 5-year treasury yields about 4.5% and a 5-year TIPS bond yields 2%. The difference is 2.5%, right? That 2.5% is the break-even inflation rate. In simple English, the market is saying, we think inflation will average roughly 2.5% over the next 5 years. Now here comes the key relationship. Nominal bond yields are made up of two things: real yields plus inflation expectations. This is the single most important relationship in the entire discussion because now you can understand what markets are really reacting to. If inflation expectations rise because nominal yields stay the same, then real yields fall. This is usually good for tech stocks. Why? Because lower real yields make future profits more valuable. Tech companies are all about long duration cash flows. A company like Nvidia, Amazon, Tesla, Meta, or Microsoft is valued heavily on earnings investors expect in future years. When real yields are low or even negative, those future profits look more attractive today because the discount rate is lower. But if real yields are rising sharply, those future earnings become less valuable in today's money. It's essentially mathematical gravity. This is why bond markets matter so much today. Now let's go back to 2020 and 2021. During the pandemic, real yields collapsed deeply negative. Inflation expectations were rising, but the Fed was holding rates near zero. That combination created one of the strongest rallies in tech and growth stocks we have ever seen. Why? Because money was effectively free when adjusted for inflation. Now fast forward to 2022. The Fed starts hiking, nominal yields surge, but more importantly, real yields surge from negative into positive territory. That completely changed the environment. Suddenly, investors could earn a meaningful real return from safe assets like bonds. That is why 2022 was so painful for tech. Not because earnings necessarily collapsed, but because valuation multiples shrank. This is where many retail investors get confused. They think higher inflation expectations automatically mean stocks fall. Not necessarily. In fact, stocks can do well during rising inflation expectations if the economy is growing. The real danger comes when inflation expectations rise enough to force the Federal Reserve into tighter policy or when they push real yields higher. Markets don't just fear inflation, They fear what inflation forces the Fed and the bond markets to do. Now let's address something slightly more advanced here. Some people measure inflation expectations using break-even rates. Others use something called the 5-year forward 5-year inflation swap rate. This sounds terrifying, but the idea is quite simple. It measures what markets expect inflation to average during a 5-year period starting 5 years from now. Central banks watch this because it shows whether long-term inflation expectations remain anchored. Now here is the reality check. Break-even inflation rates are not perfect. They can be distorted by things like liquidity, because tips are less liquid than normal treasuries, and also by supply and demand imbalances. Inflation swaps are often considered cleaner by institutional investors and central banks because they come from the derivatives market. But for most investors, break-even rates are still the simplest and most widely watched measure. Why are investors nervous today then? Because inflation expectations have been creeping higher again. Oil prices have been rising, geopolitics are messy, and markets are wondering, what if inflation stays sticky? If inflation expectations rise modestly while real yields stay contained, markets can probably live with that. But if the bond market starts forcing nominal yields materially higher to compensate for that inflation, then real yields will rise too. And that becomes a problem. Mortgages become more expensive, corporate borrowing costs rise, valuations come under pressure, and speculative assets usually struggle. So the real story here is not simply inflation is bad. The real story is what happens to real yields if inflation expectations continue rising. That's the real mechanism driving markets right now. Once you understand this relationship between inflation expectations, real yields, nominal yields, and Fed's policy, you start understanding why markets move the way they do. The scary jargon becomes much simpler. If you enjoyed this video and want more macro markets and investing content explained without the nonsense, make sure you subscribe and let me know in the comments. Do you think inflation is becoming a problem again, or is the bond market just having a tantrum? Thanks for watching, and I'll see you in the next video. All the best.